Volatility in the currency markets. Hi, my name is Dr. Gary Dayton from TradingPsychologyEdge.com, and I'm the author of Trade Mindfully, a book on cutting-edge trading psychology and the application of sports psychology to trading that was recently published as part of the Wiley Trading series. I want to talk a little bit about the volatility in the currency markets this week. The Wall Street Journal headlined this on Friday morning, saying that the currencies were on a wild ride on Thursday and Friday, fueled apparently by the Fed. The article talked about hedge funds being one of the most hardest hit when the dollar fell following the announcement from the Federal Reserve. One of the larger banks in New York, the director of their currency trading desk, said it was like a zoo trying to get filled on orders. The phones were ringing. People were struggling. They were screaming and yelling. It was apparently pandemonium. And again, hedge funds were a big part of this. First to react, and we're going to talk a little bit about the implication of the implications of the hedge funds being involved in something like this in a few moments. The other thing that the article brought out was that automated trading programs started to trade actively, and unlike what they're supposed to do, which is to provide liquidity, just the opposite happened, and there was a lack of liquidity, apparently in part at least because of the algo programs that came in. Well, let's take a look at the market. This is the US dollar futures on a 4-hour basis. And you can see the huge downdraft that occurred on Wednesday and then the rally back up on Thursday. But let's take this apart and see if we can learn something from it. The horizontal dash line is the last swing high from January 26th. And we can see that the rally actually began before it broke that January 26th high. And I drew in a green trend line there. As it breaks the last swing high of January 26, the pace of the uptrend accelerates. And as it gets above that high, it really accelerates. And in fact, it becomes parabolic. And adding the supply line to this trend line creates a trend channel. And we can see that the dollar was overbought in the trend channel, so we would expect some sort of a pullback just generally. But notice the volume on this move up. Hardly any, in fact, no pullback whatsoever, and very, very large volume. So it was what we would call climactic volume, and generally climactic volume will cause a change in trend, at least for the near term. So we start to come down, naturally so. We have a pullback down to A. Now the significance of this is it doesn't look all that large from a price perspective, but look at the volume. Again, this is wave volume, and we see that we have the biggest downside volume on the chart since that rally began just prior to breaking through the January 26th swing high. Now, admittedly, this is a little difficult to see, and it could easily elude people if they weren't really in tune to it. But here's a chart of the daily dollar futures, and that downdraft occurs where I marked it with an S, and you can see it's a down day, so there was selling on that day. And we see that there is more volume coming into the market than we had seen, not just only from the January 26th swing high, but from the beginning of the year, in fact. So that's pretty significant volume. So as we go back to the 4-hour chart, the rally up to B stalls at the highs that were created a little bit earlier. And we see that the volume just is not in keeping with the kind of volume we saw on the way up. The market then up thrusts. And by the way, the lack of the volume just indicates that the demand has dried up as we reapproached those highs. And at B, we up thrust, meaning that we peak over the top of it a little bit and then start coming down. And notice the volume down to C, quite substantial to the downside. We don't see anything like that on this chart prior to this. Now, we don't get a lot of movement down, so it's a little unclear. Is this supply, or is the supply being absorbed by buying? Well, the next rally, which is unmarked, but it would come in after C, unmarked on the chart, we see that there's hardly any ability to rally in price, and look at the volume, it's just so small. So at that point, we would know that there would be likely a bigger move to the downside. Not saying that we would know that we were going to get such a big downdraft. I don't think anybody knew that. But we could anticipate at least a pullback, at least down to the swing low of A, and probably a little bit lower, depending on how the next move down after the little rally off of C occurred. Okay. So let's talk a little bit about some of the lessons learned, or the takeaways that we can pull from this little episode to help us trade better in the weeks and years to come. First of all, hedge funds and other large trading operators get it wrong too. They're not immune to making mistakes or being positioned on the wrong side of the market. But when they do, watch out. They act no differently than the everyday trader, and they're all going to run to the exits at the same time. In other words, they become part of the herd, just like everybody else. But the key thing here is that they trade in huge size, the hedge funds and large operators. So when they're running for the exits, you've got to look out, and that's why they had such difficulty getting filled orders and had liquidity problems, because they were trying to cover or get out of large positions. Another thing to take away from all of this is that volatility comes into the markets after periods of complacency. We've had several years of government interventions where the currency markets have been, the volatility in the currency markets has been rather low. And recently the dollar has been going up, and everybody expects this to continue. We expect more of the same. But this is the time when surprises will be most surprising and cause volatility to expand dramatically. And when everybody felt like they were wrong-footed by the Fed, the Federal Reserve, volatility pops. Another takeaway is to work to stand aside or apart from all of this. Learn the requisite mental skills to be able to maintain your composure and your poise when trading the markets. I talk a lot about this in my book, Trade Mindfully, especially the sections where I bring sports psychology into trading. The elite athletes are under enormous pressure. There's a big money. There are big moments in games, and every game and every event is really important. And they need to be able to maintain their composure under pressure situations. And so some of the same skills that elite athletes use are taught in my book, Trade Mindfully. Use your chart reading ability. We walked through the chart. Now, it was not, crystal clear that something was going to happen, or certainly not crystal clear that something big was going to happen, but it was certainly clear as we look at the unfolding chart that there was enough negativity coming into the market that at least another decent pullback was in the offing. So use your chart reading skills and try to keep yourself out of situations like this. And then finally, just, nothing really earth-shaking here. always have a hard stop, even if it's a little bit far away as an emergency basis. Always have that kind of stop in the market because we never know for sure, certainly when a big event like this is going to occur. So in my book, Trade Mindfully, as I said, we cover a lot of the cutting edge trading psychology, from mindfulness to sports psychology, and how to actually get really good at trading, and to improve your trading performance. So this is available at Amazon and other large booksellers, and I would encourage you to check it out. Thank you very much, and don't hesitate to come visit us at tradingpsychologyedge.com to see more about markets and more about trading psychology.